Hello friends, today I will speak something about perpetual bonds. As we all know, the company needs long-term funds, that is capital. And a company can raise this capital either by issuing the shares in the market, which is called as share capital, or by issuing bonds and debentures in the market, which is called as borrowed capital. In case of owned capital, the company can retain that capital till the time the company is not liquidated. So there is no repayment of share capital unless the shares are bought back. Which is not so for debentures and bonds. They have a tenure, a fixed date of redemption, and on that date the debentures are redeemed or the bonds are redeemed. Secondly, shares will get return in the form of dividend. If the company earns the profit, dividends are paid. If no profit, no dividend is to be paid. Which is not so in case of debentures and bonds. Specific interest rate is mentioned at the time of issue, and at that rate of interest the company has to pay the interest irrespective of the fact whether the company has earned profit or not. The third major difference is the shares have voting rights. One share, one vote. Such voting rights are not given for debentures and bonds. So this is the basic difference of debentures and bonds. But there is one form of debentures or bonds which is called as perpetual bonds. As the name indicates, these are the bonds which are perpetual. That is, they remain constant. They are continued. There is no redemption date. There is no commitment on the part of the company to repay the amount on a specific date. Other things are similar. That is, there is a face value, or there is a fixed rate of interest, or the date of interest payment is mentioned. All these things are the same. Only difference is there is no redemption date specified. Hence they are called as perpetual. They will continue forever with the company. Of course, the company reserves the right of call option. The meaning of call option is the company can call back these bonds anytime and repay that whenever company finds it necessary. However, debenture holders don't have put option. Put option means they cannot hand over these debentures or bonds to the company for repayment. So the right of calling back is with the company, but the right of giving the debentures back to the company and getting the money repaid is not with the debenture holders. This right is given to the company, call option. Now, how these debenture holders can liquidate their investment? These perpetual bonds are listed on stock exchange, and trading takes place of these perpetual bonds on stock exchange. So if a bondholder wants to sell, he can sell his bonds on stock exchange at the rate which he can get from stock exchange, not at the face value, which is not a commitment. If there is a demand for it, the price may go up, or if there is no demand for these debentures, the price may fall. But liquidity exists in that case. Now, we must have observed that the investor has some limitations, and hence, in order to give some incentive to the investor to invest in such bonds, generally the companies offer the interest rate which is somewhat more than the prevailing market interest rate. And if this rate of interest is more, and if that is committed for all the years to come, that could be an incentive to the investor. The investors who want steady income, stable income, defined income for a long period of time, then they may opt in investing in such debentures. Secondly, these are debentures. Therefore, they have a charge on the assets of the company. Hence, they are more secured than the investment in shares. Thirdly, there is a liquidity also because these debentures are listed on stock exchanges. So you can, as an investor, you can sell this on the stock exchange and get your investment back. This is how the investors can get the benefit of it. However, there are many limitations from the point of view of investors. The first is your investment is blocked for a long period of time. Though it is said that there is a liquidity on stock exchange, but as we know, unless there is somebody to buy on stock exchange, how the holder can sell them? So there is a possibility that the investment is blocked for a long period of time. Secondly, these perpetual bonds are issued by the companies and not by the government. And hence to that extent, there is less security because these are the bonds of the companies and the safety will depend upon the company's performance and the assets. So there is a risk for the investors. Third, there is a very big risk for the investors, and that is in the form of change in the market rate of interest. Now see, if the bonds are issued, say for example at 7%, so as an investor I will get 7% for all years to come. But suppose the market interest rate goes up to 9%, then what will happen? If I invest in the market, I will get 9%. But I don't have money. I have already invested in perpetual bonds. So I am supposed to get only 7%. I will be a loser. I cannot give this back to the company. If I go to the share market for selling it, it goes without saying that the price of that particular perpetual bond getting less rate of interest than market rate, the price will be less and I will be a loser in that case. When there is opposite case, that is market rate falls and my rate is very high, what will happen? If the market rate falls, if the market rate falls, what will happen? The price of my debentures will go up. So I can sell the debentures in the market and earn profit. But if you look to the position of the company issuing these bonds, company can raise this money now at a lesser interest rate from the market. So why the company will continue with these perpetual bonds with high interest rate? Company will exercise call option. Company will call back the debentures and the debenture holders will have no option but to give these debentures or bonds to the company back. Thus, I lose in that case also. I will get my money back, but for reinvestment, the rate of interest will definitely be less. Hence, for investors, well, they cannot take the benefit of change in the interest rate, and there is always a risk in that. One more risk the investors will have to face, and that is called as default risk. If the performance of the company is not good, and the company is not able to earn profit, then in that case also company may not be able to repay these bonds. So for investors there is a risk, but for those investors who need steady income for a long period of time with limited risk, this could be a good opportunity. Of course, that will depend upon the company issuing these perpetual bonds, the goodwill, the financial position of the company and all. But if we look from the company's angle, well, companies have ample profit or benefit in issuing perpetual bonds. The first is they can raise long-term capital with a defined cost of funds. That is interest. Pay that much interest and your responsibility is over. Even if your profit is more, well, you are not supposed to share that increased profit to the investors. Thus, you can take the advantage of leverage if you issue the perpetual bonds. So shareholders will be benefited if profit is more and only interest is to be paid. Secondly, company gets long-term funds without giving the voting rights, and hence the management of the company may be retained by the shareholders. So for getting long-term funds with defined cost and without sharing the voting rights and maintaining the cost of funds, well, are some of the benefits which the companies get by issuing these perpetual bonds. This is something about perpetual bonds. Let us meet next time with some such new concept. Till then, goodbye.